Welcome to the Bound to be Rich podcast, where I attempt to reverse engineer people who seem to be successful no matter the circumstances, so that you can apply those lessons to your own life. I'm your host, Ismail Humet. One quick thing before we get started. I am starting my own email newsletter, and I would love for you to join it. It's going to be like a personal note for me to my friends of all the best things I've come across that month. From hacks and tips, interesting stories, products, books, ways to make money, and who knows what else. It's totally free. And if you don't like it, you can always opt out at any time, so there's no downside. The link to join is in the show notes, and I hope to see you on the list. In this episode, we are joined by Shehan Chandrasekera, one of the world's leading experts on crypto taxes. Shehan is the head of tax strategy at CoinTracker, the co-founder of Column Tax, and even has his own column in Forbes. He's also a renowned speaker and has given presentations at places like Google, Coinbase, Facebook, CoinDesk, and Square. On top of that, he's also a highly decorated CPA, receiving numerous awards like 40 Under 40 in 2020 and 2019, Outstanding Young CPA of the Year, and Texas CPA's 2020 Rising Star. Simply put, if you have questions about crypto taxes, Shehan is without a doubt the guy to speak to. We cover so much in this shorter interview. It may be my shortest yet most valuable interview yet. Immediately after speaking to Shehan, I set up a CoinTracker account and started optimizing my crypto portfolio for taxes. I strongly suggest you sign up for CoinTracker as well. It's like TurboTax, but specifically for tracking and reducing your crypto taxes. You can check it out for free at the link in the show notes. As we were conducting this interview, there was a large pullback in crypto and the markets in general. I wanted to get this episode out to you ASAP because you may be able to harvest tax losses on this dip. This also may be the last chance that you have to benefit from the wash sale rule. If you have no idea what I'm talking about and you own crypto, you need to listen to this one. Let's dive in. Shehan, thank you so much for taking the time to join the show. I appreciate that.
Yeah, thanks for having me.
So I was very excited to be chatting with you for a couple of reasons. One, I was fortunate to interview the CEO of Celsius, so we have a lot of crypto people following us. There's also a lot of traders following us, and that a lot of tax questions started coming up that I didn't know how to answer. So I started to reach out to my accountant, my personal accountant, didn't know anything. And I have a lot of friends who are also CPAs, intelligent people, but they really didn't know anything about crypto. So I guess my first question to you, just to set things up, is how did you land in this niche of crypto taxes? Because I think it's a great place to be in, because obviously there's a great need for it.
Yeah, so I've been a CPA for like nearly a decade now. I got into crypto around 2017, 2018 timeline. At that time, there were nobody who was kind of specializing in crypto taxes and etc. So I started reading about it, started investing, and since then I've only focused on crypto taxes.
Awesome. I see a question that, and these are also like things I've struggled with, and a lot of my listeners have struggled with. But I see a lot of people default to FIFO, first in, first out, and there seems to be debate. Like if you go to regular accountants, they say that you should use FIFO. But I think I've seen you tweet to some people that you can also use specific ID. So could you please elaborate that for the audience? What is the difference, and are you still able to use specific ID for like highest in, first out?
Yeah, so if you look at the IRAs FAQs published on their website, I don't remember the exact question number, but the IRAs is saying that you can use specific ID. In simple terms, specific ID means like you can pick and choose whatever the unit that you're selling. So you can use specific ID as long as you have detailed information about those lots, meaning you need to know the purchase price, you know the unique identifier, date sold, the market value, and etc. So as long as you have all those information with you, you can literally pick and choose whatever the unit that you're selling for tax purposes. And if you're using some type of crypto tax software tool like CoinTracker, that's going to help you achieve that automatically. Now, if you don't have all that information, then your default method of accounting is going to be FIFO. In some cases, it could work for you, and in some cases, it could work against you. It depends on your tax situation. But generally speaking, HIFO, which is a subset of specific ID, because specific ID allows you to kind of pick and choose whatever the unit that you want. So the HIFO, in the case of HIFO, you're picking the units which you pay the highest amount for. So when you use HIFO, you're reducing your taxes because you're disposing of the most expensive units.
Yeah, obviously, I think in crypto, FIFO, first in, first out, is terrible. So if you can do the specific ID, which requires tracking, so the next question is, with CoinTracker, can you use that? If someone's listening to this and they've never used it, they have this history of all these buys and, daily, like I used to do daily recurring buys. Can CoinTracker go back in time years and organize all of that for you now?
Yeah, so CoinTracker is a tool that allows you to reconcile your crypto activity by connecting to your wallets, exchanges, and blockchains and coins. So when you connect a wallet or an exchange to CoinTracker through an API, it goes back to the very first transaction that happened inside the wallet or the exchange. So yes, you do have a complete record of your history once you connect your wallet or exchange to a CoinTracker.
The other question that comes up a lot is because a lot of people trade, whether it's stocks or options, if you have losses in stock or option trading, short-term trading, can you use that to offset gains, let's say holding Bitcoin long-term?
Yeah, so the answer is yes, but there's a different way of doing this. So if you look at the IRAs code, there's a certain way that you need to net losses with the gains. So first, you take your short-term gains and offset that with your short-term losses. And then second, you take your long-term gains and net them with your long-term losses that could be arising from stocks and crypto. So you got two buckets now. And then you net each other, short-term gain or loss with the long-term gain or loss. And so when you net those two buckets, if you have like a net loss, you can only deduct up to $3,000 in the current year. Any losses in excess to that $3,000, that's going to get carried forward to future years, and then you can use those carry forward losses to offset future gains.
Is there a limit on the carry forward? Let's say you lost $100,000 trading this year. Can you carry that forward for 30 years?
Yeah, it's unlimited.
Yeah. Unlimited, okay. And so it sounds like if you have lost $100,000 trading and it's December 30th and you have a ton of crypto gains, you can sell enough Bitcoin, for example, to offset that $100,000 loss and not pay tax.
Yeah, that's right.
Okay, that's good to know. The other thing that I'm curious about is the wash sale rules, because I've seen, and by the way, I'm going to link to, you write these articles for Forbes that I think are amazing, that I think everyone should read, so I'll link to that in the show notes. But there's one that you had recently about, I forgot who it was, but someone in the government, this group in the government is trying to get rid of the wash sale exemption for crypto. Can you elaborate a little bit about what that is and how we may be able to benefit from it for now? And do you think it's highly likely it'll be removed after this year?
Yeah, so there's this document that came out of the Ways and Means Committee of the House. What they're trying to do is they're trying to subject crypto into the wash sale rule. So what that means is, so let me give an example for those of you who are not familiar with wash sales. So say that you bought a Bitcoin for $10,000, and on the next day it went down to 7,000. And what you do is you sell that Bitcoin at 7,000 on the next day, and then realize that $3,000 loss. And on the following day, you buy the same Bitcoin at the lower price, which is 7,000. So because crypto is not subject to wash sale rule, IRS allows you to deduct that $3,000 loss. But after this new proposal, I mean, if it gets accepted, you had to wait 30 days before and after you buy back the same coin which you sold at a loss. If you didn't wait 30 days, that $3,000 loss, in my example, it's going to get disallowed. So you're not going to get the benefit of that loss. This is the rule that we have been using for stocks and security transactions for a decade now. Up until this point, the crypto was not subject to this rule, but going forward, again, if this proposal is accepted, crypto is going to be subject to the wash sale rule effective January 1st, 2022. So if you talk to other industry experts, they're saying that this bill's going to pass, with this, there's no amendment for this partial rule. So what that means is like you have roughly, from today to December 31st to, maybe if you have any losing portion, to kind of sell them and buy back again and harvest those losses without having to wait that 30-day period. So there are some examples. So if you read that article, that's in the show notes, that you can see how that impacts you.
And I think it's safe to assume that will pass because everything else is treated the same way. So it's probably the last chance for people to take advantage of this rule. And you said that the next day. So is there a limit? Like, for example, as we're recording this today, crypto's dropped significantly. So if someone bought crypto yesterday, can they sell it today and buy it immediately after, or do they have to wait a day to buy it back?
You can immediately buy it back today or on the next second or the next following day. There's no restriction of buying back, but you won't be able to deduct that loss because you didn't wait 30 days to buy back under the wash sale rule, if that were to pass.
But for now, you can buy it a second later, and you can still get the loss. Okay.
Yeah.
And CoinTracker, does it do that level of tracking where it says, hey, you bought Bitcoin at 60,000, it's now, if you can sell this much and avoid taxes? I don't know if I explained that correctly. Yeah.
Yeah. So we have this, different screen called tax loss harvesting screen. So it analyzes your portfolio and it tells you, okay, if you were to sell this lot at this price, you would save this much of taxes. So yeah, the CoinTracker does that automatically.
Awesome. That's good to know because I know personally I was buying daily for a long time, and I know I have some buys above this level, so I can immediately sell that, lock in the loss, and then at the end of the year, if I want to sell some crypto, I'll be able to without a tax implication up to that amount.
Yeah.
Okay, so another question that I get often is it even worth trying to time crypto trading? Because let's say you think Bitcoin's going to go to $150,000 this year, but it'll pull back down to 100,000, right? Does it make financial sense to sell it at 150 to rebuy it back at 100? Because you'll have to pay tax, which is probably at most 20% for a long-term holding. So how do you determine whether, hey, just buy it and hold it, or you know what, it's really overextended, let me sell it, pay the tax on the gain, and buy it back?
Yeah, I guess it all depends on your personal goal, on personal financial goals. I mean, personally, I wouldn't sell or cash out anything unless I have something else better to do with that cash. And in this current economic environment, it's hard to find any asset class that's going to give you higher returns than crypto. Maybe venture capital, but then not everybody has access to that. So that's my personal kind of like a framework of thinking. But it depends on your personal situation. Maybe there's some debt that you need to pay, like student loans or something like that. If that's the case, in my opinion, it makes sense to kind of cash out, pay the tax, and pay off the debt, and go back in. So the answer to that question is really depends on your situation.
So if you're like me and your goal is to simply acquire as much sats as possible and increase your Bitcoin holdings, do you think it would make more sense to try to time it, or do you think it's just better off to just to hold it and wait? Like, is that how you think about it? You just hold it and wait?
So again, my answer may be biased. I think timing the market is such a big distraction, especially if you have high activity, maybe like a work or something else going on. So personally, what I try to do is I try to increase my time in the market versus timing the market, because market goes up and down all the time. But if you spend I don't know, like 3-4 years in this market through consistent recurring purchases, you're definitely going to end up making money in the long run. So for me, I just dollar cost average. I don't even look at the prices anymore.
And now a quick message from our sponsors. If you're looking to earn a return on the crypto that you're holding, or just earn more interest on your cash, you've got to check out Celsius. Earn 6.2% interest on your Bitcoin, 5.35% on your Ethereum, and 8.88% on your US dollar. They also pay out interest on all the other popular cryptos too. In today's world, where the banks give you nothing, My best personal finance tip is to move your savings into Celsius and earn 1,000 times what the banks give you. Literally. You receive your interest every week on Monday, so it's almost like getting another paycheck. Sign up via my link and get $50 in free Bitcoin. Pro tip, there are also often bonuses that Celsius runs. For example, right now they have a promo code STABLE50, where if you deposit $200, you get another $50 in free Bitcoin. I was fortunate to interview the CEO of Celsius on episode 13 of this podcast, so be sure to check it out if you haven't already. The link to sign up is in the show notes. All right, let's get back to the show. You mentioned that you got into crypto 2017, 2018, and if I remember correctly, I think it was the end of 2017 that it was going bonkers, like the last month of the year. So if something like that happened again, and it's going 100, 150, 200, like it's going crazy, you still don't think, you wouldn't be tempted to take some off the table because you'd know there'd be a pullback after eventually?
Yeah, I mean, so for example, I was looking at Solana. I think maybe a couple of weeks ago, it went like all the way up to 200 or maybe even more than that, and now it's like 135, 140. So I guess it's easy to get, as retail investors, we always kind of get triggered by these all-time high prices, but actually we should get triggered by the all-time low prices. This is exactly what institutions are doing, right? Because they don't buy into stuff when they're overvalued. They buy into stuff when nobody's looking at it. So yeah, I mean, I don't look at the prices anymore. And I remember the 2017 timeline. I think the Bitcoin was like trading for like 3,000-4,000 for a long time. Then it went like all the way to 20,000, went down again. But again, I thought that was a distraction as well. And now you see 20,000 to 60,000. Now today is like what, 43,000. Just dollar cost average, and in several years, like you'll be at a really nice spot.
That's good advice. So what about, I think if you were a holder, even with the question that the IRS had in the tax form this year, I think if you bought it with US dollars, you didn't have to disclose that you own crypto. I believe that was the clarification. So you could theoretically, the IRS may not know that you own crypto if you only held until this point. So for people who are worried about not having reported anything, or let's say someone did sell crypto 2 years ago a little bit and hasn't reported it, what advice do you have for them on what action to take now? Should they be worried? Do they have to go back in time and report that? How do they handle that?
Yeah, it all depends on whether you had a gain or a loss, right? Because if you had a loss, that means you lost the benefit. IRS doesn't really care about you not taking a tax benefit. So in that case, you can decide, okay, if it was like a small loss, like it doesn't make sense to amend it, because it's a loss, right? Because it's in favor of you. But if it was a big gain, what I would do is I would sit down with the accountant and amend the return, because that means there was a situation where you owed money to the IRS, but you didn't do that because you didn't record it. So now it's probably time to amend the return and pay the taxes that you couldn't pay.
I think I heard you in a previous interview mention that the IRS is very reasonable and understanding because this is all new. Do you think people would be safe to just say, hey, as long as I report it going forward, I'll be fine? Or do you think you should be that proactive and go back in time to report gains?
It's in this space, I think it's generally is a good idea to be proactive, because you see, like, IRS issuing subpoenas all the time. Like 2021, we saw subpoenas getting issued to Kraken and Poloniex. In my opinion, it's better to kind of amend the return and just be transparent with the IRS, versus waiting until your name get identified through one of these subpoenas and you get a different type of letter. So then at that point, you're viewed in a different angle than you're just voluntarily amending your return. So, yeah.
Would you mind, I know you also talk about, what is it, the 3-6 year and the unlimited rule. So it's to the benefit of the taxpayer to report something. Can you elaborate a little bit on that for everybody? Because I think a lot of people are tempted to, if you're in crypto, a lot of people believe in like decentralization and getting away from the government. So they're tempted to hide this, but would you mind elaborating why it's to your benefit to at least report something?
Yeah, there's this concept called statute of limitation. It's a technical thing, and I don't think a lot of people know about it. What that means is, if you properly file a tax return with the IRS, IRS can only come after you for the next 3 years from the date of filing. Now, if you understate your income by over 25%, IRS can come after even 6 years of filing with the return. So those are the two things, 3 years statute of limitation and the 6 years statute of limitation. Now, if you don't file any tax return, IRS can come after you forever because to begin the statute of limitation, this 3 year or 6 year time period, you need to file a return, and you never file a return. So that's why filing something is better than filing nothing, because as soon as you're filing something, you start the statute of limitation clock. So IRS legally only has 3 years to come after you.
And you mentioned before the subpoenas. So obviously the IRS is paying more attention to crypto. And I know that you've tweeted about this before, that every transaction in Bitcoin is in a public ledger. So to people that are tempted to hide or not report things, or even as Michael Saylor, I think, jokes, you got into a boating accident and you lost access to your Bitcoin. What's your take on whether it's even worth playing those games?
Yeah, so one thing that's a fact is that all the transactions that you guys are doing is online, right? I mean, it's pseudo-anonymous, meaning there's a permanent truth about that transaction, the occurrence of that transaction. So IRS has technology to, if they really need to, and they have done this before when it comes to criminal activity and etc. They can figure out the person behind those transaction IDs and wallet addresses and kind of tie it back to like a physical person, and put them through all the legal process. So I think my recommendation is that the crypto is like the worst asset class to evade taxes on, because there's always a record about you on the internet. It's just a matter of somebody like a regulator tying that address or transaction ID to you, and as soon as it happens, it's really, really hard for you to say, I didn't do that, because it's blockchain, right? It's the truth.
What about if I was in a boating accident and I lost access to my keys?
Yeah, so that's, again, it depends on the facts and circumstances of each case, right? I mean, I'm pretty sure IRS gets that argument all the time. And there was a conversation that I had with the IRS CI criminal investigation agent. In some very, very high tax evasion cases, what they do is they actually, so they go to your home or the work or whatever. They take all the assets that you have there, where they think that you store crypto, and then some people literally actually remember the 24 key phrases in their head, and as soon as they get out of the jail, they go to some other country and they recreate the wallet. Yeah, it is possible to do those type of things, but you decide whether it's worth going through all that hassle.
The other thing that I've referred a lot of my listeners to the Fold card. And now the BlockFi credit cards come out. You get to earn sats on these transactions, but there's a lot of transactions, so that's a crazy thing to track. Do you have to track it? Are those taxable?
Yeah, unfortunately, because cryptocurrencies are treated as property in the U.S., every time you buy a cup of coffee or pay for a subscription to any of these cards, those transactions are taxable if you're paying directly in crypto. I mean, again, that's if you're using a tool like CoinTracker, you can track that automatically. The other thing is that sometimes some of these cards pay crypto rewards. So fortunately, crypto rewards are not taxable at the time you receive it. It's one of those loopholes that the credit card industry has lobbied for like some time. It's very similar to you're getting these airline credits and stuff like that when you spend your money fiat to American Express or something like that. It's not considered like an income recognition event. It's considered like you're getting like a discount from the sales price. So I mean, but you still have to track those whatever the bitcoins or whatever that you're getting, because when you later cash them out, those rewards, that's going to be taxable, but at the time you receive it, that's not considered taxable.
So when you sell That's what I was asking about, is using cards like Fold and BlockFi where I'm paying in dollars, but I'm getting sats back. The sats back is not taxable. If I do sell it in the future, you're saying that they would be taxable. What would be the cost basis for those?
So that would be a zero cost basis because you just received it, without you paying anything, and then you didn't recognize any income at the time you received those rewards.
So you still want to track them with CoinTracker, and if you use the FIFO, those are the last ones you'd sell because they have a zero cost basis.
I think in this case, all those rewards would have a zero cost basis, because if we follow the theory that at the time you receive it, these rewards are not taxable, you wouldn't report it, right? So if you're not reporting it and recognizing an income, you would have a zero cost basis asset. So when you later sell them, in this case, it wouldn't really matter because all those rewards going to be zero cost basis, unfortunately.
That's a good loophole to be aware of, because I know I've earned sats that have like more than tripled or quadrupled in value, and I guess I don't own taxes on those. I didn't know that. That's good to know. So you also have this great video that I'll link to about how you can avoid $80,000 in crypto profits, right? I'm going to link to that in the show notes, but can you elaborate just very shortly? I assume that that's only if you have no other income, and that's if you're married in that example. But theoretically, if people own a lot of crypto, they never work, they can sell $80,000 a year tax-free, correct?
Yeah, they can sell $80,000 worth of long-term capital gains. That distinction is super important. So yeah, if you're married and if you want to cash out $80,000 worth of your long-term crypto capital gains, you don't have to pay any taxes. If you're single, that limit goes down to $40,000.
And does that also include, is there state taxes that would factor in as well, or is that separate?
Yes. So the state, you would have to pay state income taxes, and every state is different. Some states may have some exemptions, but generally speaking, that $80,000 and $40,000 limit, those are for like federal. For state, like you most likely will have to pay some little bit of taxes.
Got it. Okay, and I think correct me if I'm wrong, but the only way to truly avoid paying taxes on crypto is to do it through like a Roth IRA situation. And now there are these self-directed IRAs that allow you to buy crypto in the IRA. Is that correct? Is that the only way to really avoid?
I wouldn't say it's avoidance, right? Because even inside a self-directed crypto IRA, you're deferring the taxes. When you later cash out your money at your retirement, then you're going to have to pay some taxes. But the idea is that you have all these gains, and those gains are being compounded without you paying taxes, so you can have a higher return. And with that said, if you convert your Roth IRA, which you have already paid taxes on, to a self-directed IRA and then buy crypto, in that case, you would end up paying no taxes. Again, there's so many limitations and things that you need to fulfill. In that case, you wouldn't pay any taxes because you contributed money which you already paid taxes for.
I don't know if you're the right person to ask this, but I at the time that I started investing in Bitcoin in my IRA, there wasn't an easy way to do these self-directed IRAs for crypto. So I was just accumulating GBTC throughout the years. If you were to do a self-directed IRA, do you have to liquidate your entire account in order to roll it over? Can you roll over the holdings, or do you not know how that works?
Yeah, it's not my area of expertise, but you can do. So if you have a regular IRA or a Roth IRA, which is in fiat, you can roll over it to a self-directed IRA. So you have some capital inside the self-directed IRA which you can use to purchase crypto.
Got it. Okay, I'm curious. You seem to be playing with NFTs. Why are you bullish on NFTs?
I have an open mind. I don't want to say that I'm bullish. I'm not bearish either. I just have an open mind. I think it's pretty new. I just wanted to see how these things work. So I created some NFTs and put it on auction, and so I'm just playing around.
Yeah, I also want to play around. I think that it's something people be aware of, is that there's a tax it's a tax effect when you buy the NFT because you're exchanging the Ethereum to buy it. So you're paying a tax on the capital gain on the Ethereum. And then if you sell the NFT for more, you're paying a tax on that as well. Is that correct?
Yeah, so most NFTs can only be purchased by Ethereum, right? So that means you're always spending like an appreciated asset to buy the NFT, so that triggers a taxable event. And when you later sell that NFT for a profit, that also triggers a taxable event.
And final questions. I think there's a tax benefit for people that want to get into mining, to invest into mining equipment. Can you elaborate on that a little bit quickly?
Yeah, so mining income is taxed at the time you receive it. If you're mining as a trade or business, you can deduct your mining machines. You can just write them off in the first year, or any business-related expenses like internet fees, utilities, rent, and etc. You can use those expenses to offset your mining income.
So theoretically, if you invest $100,000 into mining, you can deduct that from the gains that you'd realize when you mine the coins going forward up to 100,000. Yeah. Awesome. So last questions I ask everybody. If I interviewed people around you in high school, would they be surprised at all your success, or do you think they would say, hey, this guy, he always had it in him?
I would say they were just surprised.
They'd be surprised? All right, that's very humble. All right, so we talked a lot about tax avoidance and tax planning, money, crypto. But what is a rich life to you? Because it's obviously not all about money.
I think rich life is about having the freedom to do what you want in your life. Just having more time to do what you want in your life.
Awesome, Shehan. Thank you so much. I appreciate your time. Very valuable information. I will link to everything in the show notes. Is there anything that you want to point people to in particular?
A couple of things. If you guys file an extension on your taxes, October 15th is the deadline. It's coming up pretty soon. And after that, there's going to be another tax season 2021. So make sure you're using a tool like CoinTracker to track your crypto taxes and produce the forms. It's time to be compliant, because it's not the time to kind of play a cat and mouse game with the IRS.
I totally agree. And now that I have confirmation from the expert with the wash sale, I'm signing up for CoinTracker literally after we get off this call, so I can figure out how much I can benefit from with the wash sale. So I suggest everyone does the same. All right, Shehan, thank you so much, and have a great day. Appreciate it.
Okay, thanks.
One quick reminder before I let you go to join my email newsletter. It's going to be like a personal note from me to my friends of all the cool things that have come across that month. From hacks and tips, interesting stories, products, books, ways to make money, and who knows what else. It's totally free, and if you don't like it, you can always opt out at any time. The link to join is in the show notes, and I hope to see you on the list. And there you have it. If you enjoyed this episode, please remember to leave a review. I may even give you a shout out and read yours out on the show. For any and all resources that we discussed, check out the show notes or head on over to boundtoberich.com. Until next time.